I think gold will continue in its bull market in the coming year. And the main driver by that, you do have momentum. The market, it is in a bull market, but it's being fed at the base by central bank buying. Thinking of the money supply, always think in one component is currency. That's produced by the Fed, obviously. But the big component are these liquid deposits at commercial banks. You've also got small retail money market funds. They don't account for too much, but they're in there, and that's what's going on. And right now, by the way, we're again the engine is kind of running on fumes.
The global gold market has experienced a radical surge in demand in the past 2 years, with central banks leading the growth. This trend is expected to continue well into 2025. Czech National Bank analyses have shown that if the central bank holds 5% of its international reserves in gold, its financial results will be less volatile. In practice, this means that the bank will be less vulnerable to rapid changes or fluctuations in financial markets. American economist Steve Hanke highlights his expectation that gold's bull market will continue into the next year. He explains that while market momentum plays a role, the primary factor fueling this upward trend is the robust demand from central banks. The rising global demand for gold, spearheaded by central banks, represents a significant shift in the international financial landscape. It is a warning sign for central banks and governments of developed economies. Those who ignore it will fail. More countries are seeking to diversify their reserves and hedge against irresponsible developed governments, and gold has emerged as a critical asset. From a technical perspective, Hanke explains that commercial banks dominate the money supply by creating money through loans, which make up about 75% of M2 as liquid deposits. When loans are repaid, money is destroyed. Meanwhile, the Federal Reserve's quantitative tightening and higher interest rates indirectly impact bank lending. Hanke describes the current situation as the economy running on fumes. M2 money supply in the United States has grown exponentially since the Fed started tracking the metric in 1959. As we know, this has contributed to a constant increase in the prices of goods and services. Exponential increases in the money supply inevitably cause severe devaluation in the nation's currency. According to the World Gold Council, gold has reliably tracked global money supply growth for the last 50 years and even outpaced treasury bills. Now we present the clips of Steve Hanke's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I think gold will continue in its bull market in the coming year. And the main driver by that, you do have momentum. The market, it is in a bull market, but it's being fed at the base by central bank buying. The money supply, the biggest thing in the money supply are loans made by commercial banks. That accounts for most of the action in the money supply. The other little component, not the elephant in the room, the little component is what the Fed is doing itself. So you have two things. You've got the central bank and the commercial banks. The commercial banks actually produce most of the money. And how do they do that? Well, if they loan you money, Danny, what happens? You credit your checking account, and checking accounts are liquid deposits, and about 75% rather, of all the money supply, M2 is made up of liquid deposits of banks. And when you pay off your loan, of course, that destroys money. So you've got different things. What's going on in these checking accounts is very important. Also, what goes on at the Fed, the central bank, is important. And what the Fed has been doing, they've been engaged in what they call quantitative tightening. They've been letting the bonds that they have on their balance sheet run off, mature, and not replacing them. So the Fed's balance sheet is shrinking, and that shrinkage is shrinking the money supply, slowing down the money supply. So quantitative tightening is one aspect, and they've also started increasing the federal funds interest rates, and that indirectly affects things because it affects what the banks are doing with loans. So thinking of the money supply, always think in one component is currency. That's produced by the Fed, obviously. But the big component are these liquid deposits at commercial banks. You've also got small retail money market funds. They don't account for too much, but they're in there, and so that's what's going on. And right now, by the way, we're again the engine is kind of running on fumes.
In his analysis, Steve Hanke criticizes central bankers and market participants for their data-dependent approach, which lacks a comprehensive economic theory. He emphasizes the importance of the money supply in determining nominal GDP. Since mid-2022, the M2 money supply has contracted, a rare occurrence historically linked to recessions or, in extreme cases, depressions. However, Hanke argues that this contraction has slowed inflation, currently at 2.9% in the US, and suggests it will continue to ease due to reduced monetary fuel. The mainstream political narrative suggests that inflation is permanently cooling, but the data reveals otherwise, as the money supply has grown faster in over 2 years. Money supply changes and CPI rarely follow a linear or one-to-one relationship. Still, with the Fed returning to a policy of easy money after adding trillions of dollars to the money supply in just a few years, we can expect this to fuel further increases in asset and consumer price inflation in coming years. Let's get back to the interview.
I think the big thing now is the way central bankers and market participants view things. They view it through a very short-term kind of lens. They call it data dependency. They basically have their finger in the wind. They have no theory of anything. They just have their finger in the wind. They're looking at all the data as it comes in, hour by hour, day by day, and week by week, that kind of thing. And as a result of that, they don't have a very good idea of where things are going. They're kind of they're not even really looking if anything, they're looking in the rearview mirror, or basically just what's in front of their eyes in any minute. But to look at the markets, you do have to have a theory of national income determination. And that is a theory of where nominal GDP is going to go. And nominal GDP is made up of two components. It's got the real rate of growth in the economy. And then if you add to that the inflation rate in the economy, that is the nominal GDP. So you get real GDP plus inflation, and that gives you nominal. So we're looking at what normally is called economic growth. That's the real component. And of course, inflation, which everybody looks at. And right now, the finger in the wind has been, and the data dependency has been, that inflation is still with us, and it's going up. They think it's going up. And as a result of that, of course, the bond markets, not only in the United States, a 10-year bond, the yield went way up. Gilts in London have gone way up. All the long bonds have gone way up every place around the world. So if you were long those long bonds, you would be in for a capital loss, because as the interest rate goes up, the price goes down. My view of that, I think it's misguided, because I think we not only have ended the year in the United States at inflation is 2.9% per year, and using the quantity theory of money, which is the theory of national income determination that I use, the quantity theory of money, that's what drives. The money supply drives nominal GDP, meaning real growth, and more importantly, the inflation component of that. It's driven by changes in the money supply. So what's happened with the money supply? Since July of 2022, the money supply has actually contracted. The stock of money measured by M2 in the economy is less today than it was in the summer of 2022. So what's that imply? Well, that's only happened 4 times since the Federal Reserve was founded in 1913. And all 4 of those times, we had, of course, a recession. Things slowed down. The money supply contracts, and then with a lag, usually a lag of around 12 to 24 months, you get a slowdown, in the economy, slowdown in inflation. And those four occasions where we had contractions in the past, we had recessions, or in 1929, 1933, of course, the money supply contracted by about 38%. And we had what? We had the Great Depression, but we didn't have a recession. We had a Great Depression. So the idea is that fuel for changes in nominal GDP it's the money supply. So the fuel is contracted, and that's why the inflation rate is fallen.
Gold bull markets tend to vastly outperform money supply growth, which we have not yet seen. Even a reversion to the historical mean would constitute a huge increase in the price of gold. Will central banks effectively respond to the challenges of an expanding money supply, or will gold continue solidifying its position as the ultimate safe haven asset? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.